Please join me in welcoming Governor Powell.
Thank you very much, Julie. It's great to be back. This is my third time at this conference. I think I'm 3 out of 4. It really is a unique venue to have bankers, bank supervisors, and researchers together. And I really think that the conversations and interactions that happen here are actually unique and very valuable to stimulate people thinking. And they certainly, I feel like I've learned a tremendous amount in the conferences I've been involved in. This is a particularly relevant agenda this year, and I was actually struck at the way this year's program spans the generations from our case study winners there in the back row, and up to Gene Rainbolt, who I missed Gene's speech last night. I didn't get in until late, but I did read his interview in The Banker yesterday, and had the privilege of meeting him this morning. And it's a nice contrast to have people who are just starting out their careers and people who are further along. And I will just say I hope that our case study winners will join me here in 2066 for the 54th conference. So the speeches are interesting, the case study competition is great, and the networking opportunities are great, but I would say that the research sessions form the core of the conference. And although I had to unfortunately miss yesterday, much to my chagrin, due to other obligations late breaking, I did get a chance to read all of the presentations and a couple of the papers. So I do think there was extraordinary, really good set of presentations touching on the Missouri economy and the importance of community banks, the viability of the traditional banking model, what's special about community banks, and changing characteristics of communities served by minority depository institutions. The second session was about the relationship between bank size and performance from 3 different perspectives, and I'll get into some of that in my remarks. So both of these sessions provided cause for optimism about the future relevance and importance of community banks, while simultaneously raising concerns about the viability of some of the very smallest organizations. And in my remarks today, I'm going to explore this mixed message a bit further and ask, what do the observed trends in the data imply for today's community bankers and the communities they serve? Now, where is the thing, Julie, that will... Oh, you do it. Okay, great. So when I say a slide number, they go, oh, that's great. Automation. And in doing so, I'm going to look at the national level and also at geographic patterns below the national level to look at patterns of community bank growth and decline. So I'm going to define community banks as 10 billion and under, which is standard. It's I know there are other definitions. The FDIC definition a little bit different, but it wouldn't change the results. And I'll start by looking at the number of all community banks. This is slide number 1 over the last 20 years, 1995 to 2015. So interesting. This shows a steady decline, really, in the number of community banks. And actually, the rate of decline is considerably steeper in the late 1990s than it was in the period 2000 to 2010. And then you can see again, since 2010, you see a bit of an acceleration in that pace of decline. Let's go to the second slide. So it gets interesting when you start breaking it down into different sizes. This is actually the number of banks, community banks, in the $1 to $10 billion family. And this is only about 8% of the banks. But you can see they've essentially doubled in number over this 20-year period, which is interesting. If we can go to the next slide, this is banks in the 300 million to 1 billion in assets, and they too have essentially doubled in number over the past 20 years, and they account for 22 or 23%. If you go to figure 4 and look at 100 to 300, it's about flat, a little tiny bit down, less than 5% decrease over a 20-year period. So let's go to figure 5. As is well known to this audience, this is the picture for banks 100 million or less in assets. And this is a very different picture. This really is the story of bank decline. the number of banking institutions in this size range has declined by more than 2/3 since 1995. And the pattern was particularly steep, again, in the late 90s, perhaps because of Regal Neal permitting interstate banking and branching in 1994. And I think we can sort of mechanically break down the factors that account for the decrease in the number of banks under 100 million into four categories. Some of the growth will represent banks growing out of this size range. So these are the numbers this is sort of the outgrowing way to get out of that category. And in fact, 90% of the drop-off in the last 2 years is due to banks moving up into a larger size category. A second way for banks to disappear from this space is either to merge or be acquired. A third way is failure. And finally, there are ways for this number to go up by virtue of de novos, people entering from the bottom. There is a fifth way, which would be to shrink, but that number will be pretty small. So we'll just focus on those four. So as noted in a really well-cited and known article by McCord and Prescott in 2014, a key difference between the past few years and the late 1990s is that the acceleration in the decrease in these banks is due to, in large part, to a decline in de novo charters rather than to exits. And you can see this in Figure 6. What we're looking at here is new charters is the blue line at the top, and you can see they've been functionally close to zero for the last 6 or 7 years. Then you have the actual number of community banks, which is the red line. And if you're below that dotted line, then you're shrinking. So you can see that the red line and the green line are the same thing. But the main point is, since 2010, there's really no acceleration in the decrease in the number of banks in the United States without, if you ignore charters, if you ignore de novos. To put it differently, if entry had remained at more normal levels during the past 5 years, the rate of decline in the number of community banks would not have accelerated. And since almost all new entrants have assets of less than 100 million, the decline in the number of the banks in this smallest size category would have been much less steep during the last 5 years. So there was research, many of you will remember research presented at the 2014 conference by Adams and Gramlich that considers the underlying causes of the virtual absence of new bank formation. So why would that be happening? And their research showed that slow economic growth and low interest rates in the post-crisis period, they estimated, explained about 75% of the decline in new bank charters. They weren't able to isolate the effect of regulatory changes on the rate of new bank formation, but they did note that higher regulatory expectations for de novo banks may also play a role. I see people struggling with that prior chart. Is everybody on board for this? Basically, if you look at the green line and the red line, look at the green line after 2010. It shows a small decline. And if you'd had a normal level of charters of de novos, then you would have had no acceleration. Okay, so this sharp difference in trends between the smaller banks and the larger banks naturally leads to the question of a connection to bank performance measures. Let's go back to the next slide. And so I'll look at ROA. And this I don't think will be a surprise. So what you have here is the black line at the top is non-community banks, banks that are, pardon me, that are 10 billion or greater. And right across and it's mean return on assets by bank size. So they have the highest. The next highest is 1 to 10 billion. Then you have 300 million to 1 billion, 100 million to 300 million, and then below 100 million. As you go down in size, you see a fairly consistent decline in return on assets. You also see, though, that the largest categories had a much sharper decline in return on assets, and as we'll see in a minute on non-performing loans during the crisis. And that the medium and smaller sized banks had less than that. So let's go to the next slide. the takeaway there from that slide, though, is that banks in the under 100 category had consistently the lower return on assets. So this is non-performing loans, and it's kind of a mixed picture. So again, you're breaking the banks down by size. You can see, of course, everyone peaked in 2010, and the largest institutions had the highest number of proportion of non-performing loans, and the smallest institutions had the lowest proportion of non-performing loans. But if you get away from the crisis period, both before and after the crisis, the normal state of affairs is for the smaller banks. The smaller the bank is, the more likely it will have higher non-performing loans. If you look on the far right, or everything left of the crisis, there is a link between level of non-performing loans and return on assets for the smaller banks and the larger banks. So far, these results frankly, are pretty consistent with existing literature and also with some of the papers that were talked about yesterday. Nothing surprising. So let's go forward. What we're going to do now is try to understand why. And by the way, this analysis was done at the board by Robin Prager and Dean Amel. Robin's here today. Dean is not. So they did this analysis, and to take it to the next level, we looked at it on a geographic basis and to try to say, why is all this happening? We see that it's happening. What is causing it? Are there common factors that had to do with a variety of possible things, as I'll mention? So let's go to the first map, Figure 9. All right, so Figure 9 shows those, and this is basically a local market, which could be a rural county, or it could be a metropolitan statistical area, an urban area. So this shows the local banking markets in which the number of community banks decreased over the 20 years from 1995 to 2015 in white, and those in which the number of community banks either increased or remained constant in blue. So white is number of community banks decreased, blue is either remained flat or went up. So you can see that pretty much in every state, there are markets where the number of community banks went down, and there are markets where they did not go down. It turns out that the number of local markets that saw their population of community banks hold constant or increase over that 20-year period was just more than twice the number of local markets where there was a decline in community banks. Interestingly, this was a surprise, the share of rural markets experiencing a decrease in the number of community banks was slightly lower than that, than the share of urban markets. The rural market share was 32%, and the urban market was 35%. So that was not what one would expect. As we saw, the vast majority of the decline in the number of community banks involved banks with less than 100 million in assets. So the next figure, Figure 10, it shows changes in the number of banks in this smallest size category, together with changes in the number of all community banks. The local markets that are shaded in dark blue are those where both the number of banks with less than 100 million in assets and the number of all community banks declined between 1995 and 2015. So dark blue means small banks declined in number and all banks declined in number. All community banks declined in number. Light blue are areas where the number of community banks under 100 declined, but the number of community banks overall did not decline. So I know it gets a little complicated, but again, dark blue, community banks declined all overall, and under 100 million declined overall. Light blue, under 100 million declined, but overall, the number of community banks in these markets either remained the same or went up. So there are just about twice as many markets shaded in light blue as there are in dark blue. So that in two-thirds of the markets where the number of very small community banks declined, the number of overall banks did not. So what does this show? Basically, that most markets in the U.S. have maintained or increased their numbers of community banks over the last 20 years. Those markets that lost community banks have not been concentrated in any particular section of the country, and urban markets are slightly more likely to lose community banks over the past 20 years than rural. So then the question then is, what accounts for this pattern? What can you do? We ran Robin and Dean ran a significant number of regressions to try to tease out the common factors that will have caused the patterns that we see. Because the importance of community banks as a source of small business lending and other retail services is something that we pay a lot of attention to. So the things that we considered are the possibility that underlying demographic characteristics were driving the changes. Maybe it's the size of the labor force or population density or the racial or ethnic mix of the population or changes in any of these factors that might explain the outcome. We also looked at economic conditions like the unemployment rate, median household income, number of business establishments, changes in any of these measures. Would they be useful in predicting? And so this is an ongoing research project, but it turns out that really none of these factors and others that Robin and Dean looked at provides a heck of a lot of explanatory power. So there isn't any clear story here, which either means there are a lot of stories or we haven't quite figured out the right combination. But we're still working on it. We do intend to continue the research, and we do hope that it'll ultimately yield valuable insights. We do take some comfort from the fact that the number of local markets that either maintained or increased the number of community banks is much larger than the number that saw a decline. But we do recognize that the loss of community banks may have caused some communities to suffer severe adverse consequences. So let me kind of sum up what I would take away from this review of what are the takeaways really from this information. First, the decline in community banks by number is not a recent phenomenon. It's been a constant theme for at least the last 20 years and indeed longer. Second, it has occurred almost exclusively among the smallest community banks, those with less than 100 million in assets. And I want to emphasize that the long trending decline in the number of very small community banks doesn't mean they don't play an important role in their financial system. They do. Not only that, a healthy industry will attract de novo entrants and needs to do so over time to remain healthy and viable. Almost all newly chartered banks, of course, are in this under 100 category, and many of these banks do thrive and ultimately grow out of that smallest category. So small banks should be thought of as a key source of dynamism and competition within the banking industry and an indicator of the health of the industry. Third, although the rate of decline accelerated a bit during the last 5 years, that acceleration is really due to the lack of entry rather than higher exit. Fourth, although the lack of entry may be due in part to increased regulatory burden, much of it can be explained by very low interest rates and a post-crisis expansion that has been slower than usual. Fifth, at a local level, about 1/3 of markets have seen a decline in the number of community banks over the past 20 years, but 2/3 have seen no decrease and an increase in some cases. It is unclear, unfortunately, what factors explain these observed changes in the number of community banks at the local market level. So we need more research. I think, taking a step back, I think the key question for all of us, and particularly for policymakers, is whether the recent acceleration in the rate of decline in the number of small banks is really a structural change attributable to declining, increasing economies of scale, rather, or maybe diseconomies of very small scale, or instead whether recent efforts by the FDIC and others to encourage more chartering of new banks, combined with a return to higher interest rates and stronger economic growth, will mitigate the decline in numbers. I don't think we know the answer to that today. So the Fed and the Conference of State Bank Supervisors began this conference 3 years ago in order to stimulate research on community banks with the goal of improving our understanding of their condition and their important contributions to economic growth and prosperity. We plan to continue our own research efforts at the Federal Reserve, as well as our efforts through initiatives like this conference to encourage academics outside the Federal Reserve System to focus on community banks. And of course, our support for community banks goes well beyond research. One of the clearest lessons from our most recent recession is that when it comes to bank regulation and supervision, one size does not fit all. I ought to point out that Chair Yellen testified in front of the House Banking and Financial Services Committee yesterday and devoted about 1/3 of her testimony to the sentence that I just uttered and laying out how we think about regulation and supervision of smaller institutions. As we seek to promote safety and soundness and ensure consumer compliance, we increasingly tailor rules and supervisory approaches to the differing risk risks posed by institutions of different size and complexity. We aim to achieve these goals without creating undue regulatory burden. And we're committed to this approach to community bank oversight and to ensuring that new and existing regulations are not unduly burdensome for community banks. In fulfilling this commitment, of course, we've taken an active part in the AGRIPA process. And we've taken some concrete steps to provide burden relief. For example, by publishing a streamlined call report for non-complex community banks, extending the examination cycle for banks with $1 billion or less in total assets, increasing the small bank holding company policy statement to $1 billion from $500 million, and expanding the scope to include savings and loan holding companies. We've also got efforts currently underway associated with real estate appraisal requirements, simplifying regulatory capital requirements for community banks, and encouraging resource sharing among community banks in BSA and AML. And also to use call report data and forward-looking risk analytics to identify high-risk community banks, which will make us better and better at risk-based supervision for compliance, which is something that was just being introduced when I spoke at the 2014 conference. So we'll continue to work with bankers and the other regulators to ensure that we reduce burden and complexity in our regulations and guidance. I'll just close by saying that another way that we gain understanding is by talking to bankers. And, you know, the whole board of governors meets twice a year with the CDAC Council, Community Depository Institution Advisory Council, which we call CDAC, which has community banks, thrifts, and credit unions. And there's a local CDAC council at every reserve bank, and I know Jim Bullard and the other presidents meet regularly with those councils. We also, I think almost all of the 17 members of the Federal Open Market Committee, the 5 governors and the 12 presidents, kind of speak regularly with community bankers from time to time, and I do so regularly, including many who run smaller institutions. And I find these conversations with people who work outside the Beltway and outside of Wall Street to be particularly enlightening. We get a lot of aggregate national level data inevitably in the work that we do. But for me, the story doesn't really make a lot of sense until I talk to people who are actually out making loans and, frankly, business people who are actually selling products. So I'll just close by saying that I hope the conversations we have here today will continue, and will continue to reap benefits in the form of more research and ultimately better regulatory policy and enhanced community bank performance. And I'll be delighted to answer just a few questions. Thanks very much.